Hello, everybody. Thank you for joining this video of 2022 Market Perspectives. This is Luke McCarty at McPherson Financial Group. And what a start to 2022. Not necessarily in the positive, right? The markets have been a little bit worried about inflation, the Federal Reserve interest rate risk, and now the Russia-Ukraine situation. So there's a lot going on. There's a lot out there to be negative. Historically, when there's so much negativity, that's when a bottom in the market has been found. And we've kind of seen it bounce around these low points over the last couple of weeks, starting back from, mid-January to the morning of the Russia-Ukraine invasion to just a few days ago. We opened up and kind of broke through those lows again. But I'm going to give you some perspective of what we're looking at here at McPherson Financial Group and a little bit of history on geopolitical events, midterm years, along with our economic indicators and the changes we have made in the portfolios. All right, so first thing here, the economic indicators, currently 2 are negative. This was reasoning behind some of our changes we just recently made to some of our less risky portfolios. Housing starts are negative, and then real personal income. So housing starts are negative because of supply chain issues and because you just can't start enough houses, right? They're not enough labor, not enough materials. The neighborhood I live in here, they are delaying home building because they can't get windows. So it's things that we don't think about or used to not think about are not available. So that's impacting the housing starts. Real personal income, that is directly related to inflation, right? If your income has not gone up by 7.5%, 8%, you feel like you have less money, right? That's the inflation jumping into our economy. And, now with the price of oil and the price of gas and the price of wheat and groceries, and there's a lot more things going into it now. But yeah, real personal income is negative. So we are watching these very closely. If another one of these turns negative, we have some big risk reduction techniques we're going to start deploying. All right, midterm years, peak to trough. So we are in a midterm year. If you look at this chart, right, the bottom is 2022. It is every midterm year back to 1950, right? The intra-year pullback is how much the market has dropped during that year. And then on the far right, the return a year later. So the average pullback during a midterm year is 17.1%. As of March 7th, we got about 12.5% down. And then you can see 18 was not, 19% and 7%. I mean, it goes on from there. But the far right column, right? So intra-year pullbacks are always negative because it's the pullback. And then the return 1 year later, all green on average 32%. So history doesn't, always repeat itself, but it usually rhymes. And from this perspective here, it looks like the midterm years, as we talked about in our 2022 outlook and 21 recap, our last video, we anticipated things to be rocky at the beginning, based on interest rates, based on the midterm year. Of course, we did not factor in any, Russia-Ukraine situations, but all in all, this is a pretty normal midterm year, even though it seems a lot worse because of the headlines and a lot worse because of what's going on out in the world. All right, here's geopolitical events. So how do stocks do after major events? So I talked about this on the radio. We have a podcast I'm putting in with this email that you're receiving. The event date versus the 1 month, 3 month, up to 12 months. If you look at the far right, that is, are we near or in a recession? You can see the ones that are yeses, 12 months later, the market's negative, except for 2020. So historically, if we're in a recession during a geopolitical event, it is a lot worse for the stock market. If we are not in a recession, which I don't believe we are in a recession or near a recession because unemployment's under 4%. Retail sales are doing really well. Industrial production is doing really well. So I don't think we are near or in a recession by any means. Given that, we should see on average, right, 3 months from now, about a 3.7% return, 6 months is 7%, 12 months, 10.8% down there in the green. The average, if no recession, that's where I feel like we are right now. not in the recession, but these events go all the way back to when Germany invaded France in 1940. So we're going to add another one in here, right? The Russia invading Ukraine is going to be on here next year, or next geopolitical event that'll be added to the list. But it's 37 events, and if we're near recession, it's bad for the market. If we're not, market finds a way to get through it. Here's just some quick tips on the historical market drops. I mentioned this, but as of March 8th, right, the S&P was down 12.5% over the last 100 years. This is through all market cycles, midterm, no midterm, geopolitical event, no event. But over the last 100 years, the average market drop has been 14%. So given this, we're still a little bit below average on our intra-year market drop, even though it feels a lot worse because now we're having bonds that are going down, right? The interest rate increase is causing other dollars and other investments to be down. Currently year to date, your best performers are oil, gold, and silver. Well, gold and silver haven't done anything for the last couple of years, right? Oil gets up to what its peak was $140 a barrel, and then it drops from there. So long term, what's working in the market currently isn't historically what works. This is kind of a shortened time frame where oil and gold and silver and things like that are starting to run a little bit. But the average market drop 14%. We got down to 12.5. We'll see what the future of this year holds. But it felt like, and I mentioned before, that we're finding a bottom in the market. Portfolio changes. So we replaced SWAN, the ETF SWAN, with BUFD, a buffered ETF. The reason we did this is because SWAN has interest rate risk. When the Fed starts raising interest rates, they're going to start this month, right? That's going to impact SWAN because SWAN has long-term treasuries in it. So historically, it's a pretty safe investment, not a very volatile investment, but it has been very volatile as we're seeing moves in the interest rate markets that we haven't seen in quite a while, right? We're seeing 6-7% swings on a daily basis the last couple of weeks. So we removed that BUFD, right? A buffered ETF. So it is a deep buffered ETF on the S&P 500 ran by First Trust. So it is a monthly ETF. So every month they come out with a new one, right, for that month that lasts for 1 year. The BUFD is a combination of all 12 of them in a laddered portfolio. So every month we get into a new S&P 500 investment for that year, for that month. So that 8% every month is kind of turned over, but because it's in an ETF, it's very tax efficient. What this deep buffered ETF does is it is the S&P 500, and you as the investor in the ETF for that month, for each year, right? And within that, you start on that month, and that's your 8% of the portfolio for the year, right? But if you go over all 12 months, right, your risk is covered from down -5% to down -30%. So if the S&P 500 is down 10%, we should expect this to only be down 5%, right? So you are covered for any losses between -5 to -30. Now, it sounds really good to be true. It is very flexible, very liquid. We can get in and out of this however we want to, but there is an upside cap. So because of all the options they are writing to limit the downside, there's an upside cap that fluctuates. It's approximately 7%. So we are not going to outperform the S&P on the upside, and on the downside we will, but we're using this as a bond alternative, which is what we originally had used SWAN for. This does not have interest rate sensitivity. This has a lot of protection on the downside. You can see in this little chart, this was for last year. The beta is what the market moves. So this kind of moves about 24% of the market. And then standard deviation of 3.25 versus the S&P close to 13. Standard deviation is your measurement of risk and your volatility. So this is going to help smooth the ride. And if we can get anywhere, any positive number right now for a bond alternative is going to be a win, but our upside is approximately about 7%. So we made this adjustment to the portfolios to help reduce risk from interest rates rising. All right, please contact us if you have any questions. Once again, I'm Luke McCarty. You can email me, email Art. There's our office phone number. And then there's some of our disclosures. But thanks for listening, and call me, email me with any questions you have.